Bloomberg Audio Studios. Podcasts, radio, news.
So, Merryn Talks Money listeners, or at the very least the London-based ones, have you actually done it? Have you signed up to join us at Bloomberg's European headquarters in the heart of the city on November 27th? We will be taping an episode of the podcast in front of a live audience the morning after the UK budget. I will be joined by Helen Thomas of Blonde Money, Stephanie Flanders, Bloomberg's head of government and economics, and of course, John Stepek will also be there. So if you haven't signed up yet, find the registration link in the show notes and do join us. We hope to see you there. There will be coffee, there will be croissants. On to the episode. Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the market this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
Excellent. Hi, John.
Hi, Merryn.
Now, listen, I know that, it'd be nice to have a little casual chat right now, but there's literally no point because all you can think about is the housing market. Yes, as regular listeners will know, John is absolutely obsessed with house prices in the UK, and the latest RICS survey is just grist as mill.
It's just fascinating stuff. Well, actually, I suppose it's not that fascinating. There's an awful lot of estate agents saying that they're nervous and the buyers are nervous ahead of the budget, that people are putting off sales, they're putting off buying. They're a little bit gloomy about how things are going to go over the next 3 months, but they're not that gloomy. And basically all points to prices being kind of flat to lower, assuming that the budget goes broadly according to plan. That's just quite a big assumption. But the one thing I would say is, and I think is probably more important than any of this stuff, is the fact that interest rates have been steadily dripping lower and mortgage rates have been steadily dripping lower. And the one thing that you and I know from years and years of better experience is that really house prices are driven by one thing, and that's the price that somebody can get a mortgage for. And the reason that they've been flat to falling for the last 3 years is because mortgage rates obviously shot up with interest rates. And now that they're kind of just ever so slightly dropping lower because markets now expect the Bank of England to have to cut interest rates more, I suspect that we might see house prices not go up a lot, but kind of move away from the flat line maybe in the next 6 months.
Yeah, I mean, that's an interesting point, John, and you're right. We always say that the price of a house is about the price of money. But it's also about some of the uncertainty. So at the moment, we're in this hopefully short-term situation of huge economic uncertainty and concern about what taxes might come up in the budget. And there's lots of concern about new property taxes, new wealth taxes, changes to the council tax regime, etc. And an awful lot of people feel very uncertain about buying a house at all, let alone paying over the asking price by any means for a house in this kind of environment, right?
Oh yeah, absolutely. I think, to be fair, I think that mostly affects people at the wealthier end of the spectrum.
Yeah.
Mainly because, they're the ones who will be sitting there going, right, well, if I put this off, I'm going to be able to see how hard she's going to hit me and whether I actually want to go ahead with this or not. I mean, it's kind of slightly different if you're moving at, maybe under £500,000 or under £750,000 if you're in London. And it's just, well, look, you just got to get on with life. It's not like you can leave the country if you don't like what Rachel Reeves does. It's not like you've got an awful lot of evasive action things that you can do. So I think at that end of the market, it probably doesn't actually have that much effect. It's just a useful, kind of conversation piece for estate agents to talk about. But definitely the high end.
The other thing I think is useful to point out is that even if house prices over the full year do reach the level that most analysts are forecasting of, say, 2.5-3% growth over the year, we're still looking at things being flat in inflation adjusted terms at best. And in fact, house prices have fallen quite a lot in inflation adjusted terms over the last few years.
Yeah, and that's actually, I find this really interesting because when you think about how buoyant things like equities and gold have been, the fact that house prices have probably for one of the first times in my career been the least interesting asset market for a prolonged period of time now. To the point where people are actually sort of getting the message. There was a very good piece, posted it out on LinkedIn yesterday, from a chap who was talking about how he'd bought a flat in 2016 and rented it out. And he was basically explaining how over that whole time, with the changes to taxation and buy-to-let, and also with the fact that capital gains have gone nowhere, because this was in London, so it's been about flat for 10 years in London. He'd worked out that he'd been paid less than minimum wage for all the work he'd done running this side business as a kind of amateur landlord. And he basically said that it was a complete waste of my time. I should have sold it and put all the money into equities. And I haven't heard much stuff like that, even though it's probably been true for at least kind of 5 or 6 years now. So it's really interesting that I think people are starting to get out of the mindset of you can't go wrong with bricks and mortar.
Yeah, I mean, it's interesting, isn't it? Because it used to be that there was so many problems with buy-to-let, and we got to the point where I remember us making various calculations showing that the average buy-to-let investor was actually cash negative on the average month. But nobody cared, because if they were making great capital gains, it was still absolutely worth it.
Yeah.
But if you're not making capital gains, suddenly it turns into a bit of a nightmare.
Yeah, and it is that. I do think it's also that thing. I thought it was really sensible. The guy made the point, I'm actually having to manage this. So whereas my equity portfolio never phones me up and says the toilet's broken, that happens with my kind of, do you know what I mean? It's a low maintenance kind of business running an equity portfolio. Whereas you're kind of taking up your weekends and your spare time stressing about things, and you want to get compensated for that as well. So even if you are managing to make some money, it's got to be worth your actual
real
while.
Money.
Yeah. So I thought that was really interesting.
It is interesting. Okay, so moving away from that and the idea that there may finally be the beginning of a change of mindset about property prices in the UK, or about, my property is my pension and all that kind of thing that we've written about a lot over the years, we are suddenly seeing, despite the appalling political shenanigans in the UK and the miserable state of the UK economy, growth coming in at almost nothing in the last quarter, we're still seeing the equity market doing rather well. And it's kind of exciting. We have this idea that quite soon we'll go through 10,000, right?
Oh, that would be great. I can see the FTSE doing its usual and just really horribly teasing us all, as it has been doing this week. But yeah, there's no reason why it shouldn't get to the big round number of 10,000 at some point before Christmas, assuming that the American AI bubble doesn't pop before then and just ruin everything for everyone.
Which, by the way, we should say, by the way, that this still leaves the FTSE very significantly down from its peak in inflation-adjusted terms. So, 10,000 might feel nice, but you will still be down in real terms.
Oh, that's such a spoil sport. That's not on total return terms, though. It depends on when you purchased it.
Okay. All right, little Mr. Optimistic.
I just like to put all the facts out there.
Round numbers are exciting, but they don't always tell you the whole truth. And we should mention, by the way, while we're talking about the FTSE 100, that 3i Group has had a bit of a nasty day. We're talking on the day when its results came out, and it fell, I think, at one point down sort of 15% or so. And that's... I think partly because people are suddenly noticing the extent to which it's dependent on one company. So it's got an awful lot of the portfolio, sort of 70% of its total asset value in a Dutch retailer. So it makes it sort of very top heavy, and it's also trading at a premium to its NAV. So there are various things to worry about with that, but I think a lot of people probably have it in their portfolio. So just a heads up that just because the FTSE 100 is doing well does not mean that every constituent in it is doing exactly what you want it to do.
Yeah. I mean, it has been a good week for some of the stocks, but that is quite a big one.
It is. And it's also, you always think of it as a private equity portfolio, don't you? So when you suddenly realise that, in fact, it's a large retailer with a couple of little private equity things around the edge, it's a slightly different kind of portfolio. Anyway, leaving that aside, UK growth, do we want to talk about the miseries of that?
Do you know what? I find GDP figures really just send me to sleep. It's terrible. They're so constantly revised all the time, and all you really need to say, what if it had been 0.2 instead of 0.1 okay, the response would have been a bit more positive, but it's still rubbish. So I think all we could say is that the economy continues to be very, very sluggish. And it's basically down to incredibly bad management, not just by this government, but by previous governments as well. But
many previous governments, but certainly the run up to this budget is not helping. I mean, we were talking before we started recording, weren't we, about all the different taxes that might come and go, everything from changes to pension tax to different income tax bans to, God, I don't know, salary sacrifice and not being able to put your expensive bicycle through. I think I slightly approve of that one, to be honest. Should you really be able to put through those expensive bicycles? I don't know.
It's the pension bit that bothers me a little bit more, I have to say.
Really?
Well, the idea is she's going to cap it.
Bicycles.
No, the idea is she's going to cap it at 2k. That's not very pleasant for anyone who's attempting to kind of save for their retirement during their peak earnings season.
What do you mean? And she's not going to cap what you can put into your pension to 2k?
No, but it's going to cap the amount
No.
do salary sacrifice on.
Yeah.
Before your employer's going to have to shell out national insurance and you're going to have to shell out as well. So it's that kind of thing.
I know.
I mean, and again, it might not happen. It's like, but I mean, you're right. I think the problem is that on the one hand, the fiscal Overton window has been blown wide open. So, a while ago, there were certain things you could say, okay, the government's stupid, but they're not going to do this because that would just be so obviously a bad idea. And so there was a group of policies that they would do. The difference is now someone could come in and just make something up. And you still wouldn't have any idea if it was actually going to happen or not, because anything goes. And this is partly the result of the havoc at the top, because there is clearly a war at the top for who gets to say what's going to kind of be in the budget. And Rachel Reeves is worried because obviously she's worried about appeasing her own party members and kind of, the gilts market and also the voters. And I think obviously she's thinking, right, well, am I actually going to survive this? And that's why we're also hearing talk about getting rid of this 2-child benefit cap, which is clearly not an affordable situation or choice. And it hasn't become any more affordable since she said it was unaffordable last year. But it's a kind of sop to the left wing in her party.
I mean, I suppose it's also worth noting that when we talk about the 2-child benefit cap, a lot of the conversation around it sort of suggests it's not possible to have more than 2 children. And of course, you can have as many children as you like outside the benefit system and also within the benefit system. And there are only certain parts of the system that are capped at 2 children. There are...
Yes.
It's a complicated system. It's a very complicated system. The UK benefit system is much more complicated than most people realise. And in fact, we've been chatting earlier, and I would encourage anybody who's interested in how the benefit system actually works and what you can and can't get on welfare to go and look at a website called entitled2.co.uk, where you can input all sorts of different variables and find out for yourself exactly how it works. It is complicated. It is complicated.
Yeah, you might also find that you're entitled to something that you didn't know you were.
That's not what we're encouraging.
I'm not encouraging it, but I think a lot of our listeners would be surprised if they were to
That
go
is
on
true. They might be surprised to find that they are inside the system. Anyway, moving on from that, this is not a program about how to claim benefits. The TikTok is available for that. Let's move on to talking about the US market. There have been quite a few interesting pieces on Bloomberg about this recently. And so there is, for starters, let's say that there's been a report from Peter Oppenheimer at Goldman Sachs, who points out that US equities are likely to lag other markets for the next decade or so. This is all about if you're going to invest, the starting price is what matters. And he expects over the next 10 years to see 6.5% from US markets, which personally I think is ambitious. But he's looking at totally different numbers for other markets. So emerging markets, 10.9%. He sees those as the strongest over the next decade. Now, of course, the thing to worry about in the US is the great AI bubble, which I think you also think is a bubble. I think we're as one on this bubble thing, aren't we, John?
Definitely. I think we've got to acknowledge that just because you think something's a bubble doesn't mean that you have any idea when it's going to pop. And it also doesn't
absolutely.
Really, to a certain extent, it is meaningless. But there's been a lot of interesting stuff come out about it, and I think that we're starting to get a better sense of where the problems lie. And it's sort of this whole thing about, do you want to talk about the chip depreciation?
Yeah, I do. But I want to briefly mention things that now people are now talking about in a much sort of wider and louder way than they were previously. I mean, we've talked before about the energy problems of AI, the ability for data centers to connect to the electricity that they need to keep things going, and the extent to which data centers are already using vast amounts of electricity in the US and indeed in the UK. So there is this limiting factor of energy that is beginning to be discussed more outside the niche areas that we're discussing it previously. And then there's also the infrastructure issues. There's a lot of people who want companies that want to use a lot of data center capacity and are finding that the data centers aren't going up fast enough. Right, so you've got an energy problem, you've got an infrastructure problem, and then, as you say, you've got this quite interesting depreciation issue.
This is interesting. I'm not like completely across it, but the basic point is that for AI to work, these companies need to keep investing in very expensive microchips. And the issue is that these things have an uncertain shelf life. So if you want to keep up with the latest AI, you need to keep investing in the latest chips. But that means that the ones you spent, hundreds of millions of billions of dollars on 3 years ago are no longer as valuable on your balance sheet as you thought they were going to be. And and basically the amount that you're having to write off every year is, you're already investing a lot, you're writing down a lot, and are your kind of revenues going to actually cover that? And then on top of that, you've got all of these slightly weird circular deals that they're all doing with each other, where somebody buys the chips but then they rent them back off them or whatever. And then on top of that, you've got the interaction of private debt markets with all of this. So where's the funding coming from? How opaque or not is it? What happens if the smaller players particularly start to kind of go bust or be unable to keep up with their payments, that sort of thing? So you can see that there's a running out of road element to it.
I mean, I suppose that just to go back to the depreciation, the key point is that there is an idea that possibly the big companies are underestimating depreciation. They're not doing it fast enough, and that makes their balance sheets look rather better than they should, right?
Yeah,
their accounting assumptions are just a little bit too generous. Now that brings us back to something we were talking about last week, to this idea that J.K. Galbraith had about his term, the bezel, right? Which he wrote about in The Great Crash, his book on that Great Crash, 1929. And shall I read you the paragraph? Might as well. Alone among the various forms of larceny, brackets embezzlement, has a time parameter. Weeks, months, or years may elapse between the commission of the crime and its discovery. This is a period, incidentally, when the embezzler has his gain and the man who has been embezzled, oddly enough, feels no loss. There is a net increase in psychic wealth. At any given time, there exists an inventory of undiscovered embezzlement in, or more precisely, not in, the country's business and banks. Now, he's talking here about the bezel, this idea that there is a period in each bubble where there's a lot of fraud and corruption, larceny, embezzlement, whatever you like to call it, that people don't know about, and when they begin to know about, this inflated sense of value collapses. Right?
Yes, and to be clear, we're not talking about anyone doing anything illegal.
I am moving on to that. But so he talks about things that are basically illegal or close to illegal. Yeah. I mean, he doesn't push the whole idea on quite as far as some other people have. But since then, Charlie Munger at Berkshire Hathaway, I mean, he sort of developed it in to more about the story, when the story isn't quite true, or the story doesn't help you understand everything. And this too creates a sense of psychic value. So the bezel is the word for the disconnect between what you think the value of an asset is and what you will come to understand it is over time. That's also the bezel. So it's not necessarily about illegality, but it is about things like vendor financing, that kind of circularity that we've talked about before. It is about perhaps getting your depreciation slightly wrong and making things look better than they really are. It's about all these things that aren't necessarily fraud. They're not larceny. They're not actually embezzlement, but they are part of the bezel that comes towards the end of most bubbles.
Yeah, it's the stuff you can get away with because everyone wants to believe.
Yeah,
firmly. And I do, yeah, and it's interesting to see that this is the sort of, we're starting to get signs of where that might crop up. And I think that sort of, again, you're getting the sense that people are looking at AI and starting to ask, okay, so how is this going to actually pay off now? You've got a little bit beyond people just unthinkingly just buying into the hype and starting to say, right, so where's the payoff? Like kind of expectations are starting to crystallise a bit. So we're interested to see what happens with that. I still find it's fascinating stuff because I am not an AI skeptic. Things are clearly happening in some industries more than others. And people, it is having an impact on certain jobs in some places. I was reading another piece in Bloomberg this morning that was pointing out that a lot of banking customer service layoffs have been driven by AI, and I can see things like that happening. So I guess it is like the .com boom all over again. Something big is going on, but simultaneously we can also have a big market crash simply because we priced in too much too soon.
And so it's probably the point in the cycle when people heavily invested in the US should wonder what part of their wealth is psychic wealth and what part of their wealth is real wealth.
That's an interesting one. It's a bit like your household balance sheet for your house price in the UK. You may need to adjust that depending on when you bought your home.
Exactly. How much do you think your house is worth and how much is it really worth? I remember again, I will just say, I don't know how often I tell you the story, but I'm going to tell you it once more about that wonderful survey, possibly my favorite survey ever. It must have been 2009-ish, asking people in the UK about house prices in the UK and what they expected. And everybody said house prices are falling across the UK and going to continue to fall across the UK, but they're not going to fall in my neighborhood because we have a special community or a really great pub or a marvelous market or the best school or whatever it is. And so people went into a period of absolute denial about their own houses while accepting that the nominal price of everybody else's houses was going to fall. We may be approaching that period again.
Well, at least we might get some comedy surveys out of it.
Oh, I'd love to see that survey again. Obviously I can't actually find that survey. I've been looking for it for ages so that I can actually read you bits of it because I loved it so much. I can't find it. In fact, when we finish this, I'm going to look for it again. In fact, we're going to finish this right now so I can go look for it again. Okay. Thanks, John.
Thanks, Mel.
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to your podcast. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.